Okay, we want to talk a little bit more about what to consider as an investor right now. Right now, we are seeing North American equities a little bit higher, but the trend recently has been a negative one. Kurt Reiman has more than 2 decades of investing experience, a longtime investment strategist, joining us with his perspective on the markets right now. Kurt, great to see you. And I mentioned earlier in the program, I guess the stat that really stood out to us was the fact that the TSX had not 5 or 6, but 7 straight days of weakness. I mean, how would you characterize the mood of investors right now?
Yeah, I would say that the rise in bond yields has really been troubling, and we've come into an earnings season that's a bit more mixed. Now, I would say that against that, this has been a year of fairly low expectations, right? I mean, if we think about the setup coming into 2023, economists expected that we would be in recession by now, and that earnings would fall, according to most strategists, by 10 to 15%. We didn't see that happen, right? We are actually in a pretty good spot relative to that. I think we're exceeding what was already a pretty low bar. And you know, there's lots of reasons we can go into about why this didn't come true. But at this point, I think looking into 2024, and I think that's what investors are starting to do, they're looking ahead to the next year. And we've got, for the TSX and for the S&P 500, we've got about 12% earnings growth penciled in for next year, according to stock analysts. And if that recession that was expected at the beginning of this year hasn't happened yet, and rates are rising, credit conditions are tighter, savings has been more or less depleted, even if consumers feel wealthier, inventories have been rebuilt, it goes to question whether or not we can deliver this, you know, sort of above the typical year's earnings estimates of 12% when the economy may sputter next year. So I think that's the reason why we're looking at some weakness in stocks here.
Now, just to take the other side of it, if you're looking at those dynamics and you're saying, yeah, I mean, I might as well just put my money in cash and wait it out, is there a case where all of a sudden the sentiment turns?
Yeah, you know, this has been the situation this year. I think advisors have been, you know, really grappling with 2 things. One is if there's new money to be put to work, it's being parked in money market funds or cash. Or they're hearing from their clients that with 5% at the front end of the curve, why not just liquidate everything, right? There's this caution, there's this point of view of nothing looks good right now. I would be careful about that. I would still be, you know, adhering to the 60-40 portfolio benchmark. I'd be looking for selective opportunities within stocks. And in particular, I would be looking over at fixed income and thinking a lot about whether a 1-month or a 2-month cash rate or, you know, cash-like rate is what I want, or do I want to lock in an interest rate that's higher than we've seen for over a decade. I think there's some opportunities really coming into sight here within fixed income. It's time to be lengthening duration. It's time to be picking up some of these opportunities here.
And then just a final question. I know that the idea of keeping defense in mind is part of your thinking right now. The part I always find really tricky, we saw quite a turnover in some of the tech stocks recently, but you always hear people say, well, hold on a second, if it's a tougher environment, those biggest technology companies have a lot of levers they can push and pull, and I'm really curious to see if investors would be so bearish that they would shed those stocks from their portfolio.
Well, John, I do think it's about getting some balance here. You know, we saw back in the tech, media, and telecom. I mean, obviously there are differences then and now. There are also some similarities, and I tend to be one of those investors that thinks that when you get this kind of sector concentration, meaning the share of tech and tech writ large, you know, so not just IT, but in the US, when you look at communication services, when you look at consumer discretionary, there's a lot of tech there too. And also there's this whole notion of the top 7 or the top 10 companies. delivering the lion's share of the gains this year. Those issues concern me. On top of that, we talked about the 12% earnings growth for the overall market next year. Where are analysts expecting most of that to come from? Well, it's coming from this tech and tech adjacent complex. It's high teens earnings estimates next year. So that has to deliver. And then I guess we should be also thinking a little bit about how regulators now are looking at some of these incumbent tech firms in both the US and in Europe. This headline risk becomes more of an issue if companies aren't beating estimates, and it's a distraction to management. So I would be, looking at some of the opportunities in the more traditional defensives. Here I'm thinking consumer staples, also a little bit within healthcare. These have gotten punished with the rise in rates, but their valuations are starting to look more attractive.
All right. Well,